Hello everyone, welcome to today's lecture. So today's lecture is Unit 1, Lecture 3, What is the Fed? So this material comes from Chapter 4. Some things that we're going to ask ourselves today is why was the Fed created? What is the Fed? How is the Fed structured? What does the Fed do? Those are just a few of the topics that we'll cover in today's discussion. So our learning objectives: 1. What is the Federal Reserve structure? 2. What are the Fed's goals and responsibilities? 3. How does the Fed conduct monetary policy through open market operations? And we'll also talk about how they affect monetary policy through changing the discount rate and also the reserve requirements. And what is the theoretical impact of monetary policy on the economy? So before we get into what is the Fed, let's kind of discuss why was the Fed created. So once again, this is some extra material to kind of just set the stage as to why the Fed was actually created in the first place. So between 1820, from the 1820s up until about 1913, there was not a central bank in the United States. This changed after the Panic of 1907. So what was the Panic of 1907? Well, in 1907, there was a lot of speculation in the commodities market caused primarily by an earthquake in San Francisco. So a lot of individuals drew all their gold out of the world's major money centers, which caused a liquidity crunch. As a result of this, there was what was called a bank run or bank runs at the New York City banks. A bank run is when depositors pull out their money all at once from financial institutions. The banks don't have enough to cover these withdrawals. Also, in addition to these bank runs, there was a stock market crash. So to try to deal with this panic of 1907, the economy turned to two individuals. First, J.P. Morgan. So J.P. Morgan was a New York City banker. He was able to obtain $25 million of U.S. Treasuries, which he deposited in these New York City banks. They also turned to John D. Rockefeller, who was the richest man in America at that time, and he deposited $10 million into these New York City banks, which actually saved the banks. So after this intervention by J.P. Morgan and Rockefeller, the government realized we need a central bank to try to eliminate these different types of, or this scenario from happening again. So in 1913, the Federal Reserve was created, and their primary reason of creation was to ensure a stable monetary system. So the Federal Reserve was created. Let's talk about what is the Fed. Well, the Fed is the central bank of the United States. Well, we keep using this terminology of what is of a central bank. Well, what is a central bank? Well, central banks determine, implement, and control the monetary policy in their home countries. So most countries, I believe it's over 75% of all countries have a central bank, but they control the monetary policy. Monetary policy is primarily dealing with money supply and interest rates. So they're trying to promote economic growth by dealing with the money supply, so how much money is available, which in turn impacts interest rates. What's unique about the Fed is that the Fed's decisions do not need to be approved by the U.S. president. So they are an independent central bank. However, they are objected to oversight by U.S. Congress because they do have the authority to coin money. Even though the Fed's decisions do not need to be approved by the U.S. president does impact who is on the Fed. So the U.S. president appoints members of the Board of Governors, and then also selects the chair and the vice chair of the Fed. We'll talk about who these positions are in the next couple of slides. Additionally, the chair of the Fed does have to testify before Congress. If any of you do not know, in February of 2018, we had a new chair of the Fed. His name is Jerome Powell. He took over for Janet Yellen. But he is still currently the chair of the Fed. He does have to testify before Congress, even though they don't need to be approved. His decisions don't need to be, the Fed's decisions do not need to be approved by the U.S. president. And then lastly, the Fed is still relatively independent from a central bank, or a relatively independent central bank, especially when you compare their independence in comparison to other central banks around the country. What this means is by saying that the Fed is relatively an independent central bank, they don't have the political pressures, right? So they're more able to really focus on monitoring the economy and making decisions that would promote economic growth. One thing that I failed to discuss, and I kind of want to discuss real quickly here, is this control of monetary policy. So I mentioned that monetary policy deals with money supply and interest rates. Don't get this concerned with fiscal policy. Okay, fiscal policy is the use of government revenue. So the use of government revenue collection expenditures that influence the economy. So we're talking about taxes, road constructions. There's a difference between monetary policy, which is money supply and interest rates, versus fiscal policy, which is dealing with government revenue. So let's discuss how the Fed is actually structured. The Fed is structured with a 7-person board of governors. You have a chair, a vice chair, and you have 5 other members. We already said that the chair is Jerome Powell. And again, these are appointed by the U.S. president. They are actually staggered. Every other January they replace. The 7 members are appointed by the president, as I mentioned. They serve non-renewable 14-year terms. And primarily these 5 other members serve 14-year non-renewable terms. The chair and the vice chairs choose 4-year terms. So the reason why they have such long terms is so that one president can't influence the entire board of governors. Since they serve non-renewable 14-year terms, you don't have one president that can appoint all 14 or all 7 members of the board of governors. So you have 12 Federal Reserve banks. These 12 Federal Reserve banks are spread across regional lines. So within these 12 Federal Reserve banks, you have these 12 U.S. district banks. Each of them has a 9-member board. So you can see that we have 12 different districts spread upon the old regional lines. And within each of these districts, you also have branches. So looking at Ohio here, the Federal Reserve Bank in Ohio would be in Cleveland, but there's also a branch in Cincinnati. So the Federal Reserve Board of Governors and the Federal Reserve Banks make up and operate what is called the Federal Open Market Committee. We will discuss this in future slides. I just kind of wanted to bring it up here. But this Federal Open Market Committee is responsible for the formulation and implementation of monetary policy. So their primary duty is to deal with monetary policy, which we discussed previously. So their main goal for the Federal Open Market Committee is to conduct monetary policy. And I just wanted to let you know that the Federal Reserve Board, so these 7 members, in addition to these Federal Reserve banks, make up the Federal Open Market Committee. So as I mentioned, we'll talk about that more here in a little bit. Let's continue with how is the Fed structured. So each Federal Reserve bank acts as a bank for all the other banks within its districts, right? So they are considered the bank of last resort for all of the banks within their district. The Athens banks here are under the jurisdiction of the Federal Reserve Bank of Cleveland. So they are in that this red area here. Their Federal Reserve Bank is in Cleveland, so they are under their jurisdiction. All nationally chartered banks are required to become members of the Federal Reserve System, okay? And all these nationally chartered banks in the district must keep reserves at their Federal Reserve Bank of that district. So there are 2 different types of reserves. The first type of reserve is called a required reserve. This is a percentage of deposits. So this is the minimum amount that you must keep in reserve at your Federal Reserve Bank. So for example, let's say Chase had $10 million of deposits. If the percentage of deposits or the reserve ratio was 10%, they must have $1 million in reserves at their Federal Reserve Bank in that district. The other type of reserve would be excess reserves. So this is simply reserves above those required reserves. Now, if one bank happens to be short on their required reserves, they can actually borrow another bank's excess reserves to meet their required level, to meet that required reserve percentage. This is typically occurs over the federal funds market. So if it's between 2 banks, 2 financial institutions, you would use what is called the Fed funds rate. Again, something that we're going to discuss in more detail. That's why it's called the federal funds market. If it happens to be, so if this is from bank to bank, that's what you would use, the federal funds rate. If it happens to be between the Federal Reserve Bank in that district and the bank, then you would use what is called a discount rate, and that occurs in emergency situations. Both of these scenarios, the different rate that you would use for banks borrowing between one another, will be discussed in more detail here in the upcoming slides. So, moving forward, what are the Fed's goals? So what are the Fed's goals? What do they do? What are their responsibilities? Well, the Fed's goals are, first and foremost, their original mandate was to promote stable monetary and financial system. So after that bank run and the Panic of 1907, they were created to promote a stable monetary and stable financial system. Other goals are to create stable prices, have low inflation, and then during the 60s and the 70s, they were tasked with economic growth in addition to full employment. And it's important to keep in mind that the decisions of the Fed affect other countries as well. So they are also, another goal is to promote a sustainable pattern of international trade. So these decisions by the Fed do impact imports and exports, currency exchange. So that's another one of the Fed's goals. So what does the Fed do? The Fed's major activity is conducting monetary policy. So what did I say monetary policy is? That deals with the money supply and interest rates. Okay, so this is dealing with the demand side of economic policy. Now, the Fed will conduct this monetary policy in one of three ways. The first way is through open market operations. This is the primary method, and you're going to see that the Fed also has another committee that helps with this open market operations dealing of monetary policy. The other two methods would be setting the discount rate and also setting the reserve requirement ratio. So the first one that we're going to discuss is open market operations. So open market operations are controlled by the Federal Open Market Committee that I discussed previously. So that is the 7 board of governors of the Fed in addition to Federal Reserve banks. Now, banks trade their excess reserves. So remember, they have two types of reserves: required reserves and excess reserves. Banks can trade between, if one bank is low on their required returns, they can trade with another bank that has excess reserves. And the rate that the bank that has the excess reserves would charge is called the federal funds rate. So this federal funds rate is the rate that banks charge each other on loans of excess reserves. Typically, these are one-day loans. So who monitors this federal funds rate? That is the Federal Open Market Committee. So who makes up the Federal Open Market Committee? You have all board of governors, so those 7 members, the chair, the vice chair, and the other 5 members. You have the president of the Federal Reserve Bank of New York, which is the largest Federal Reserve Bank. And then you have presidents of 4 of the other 12, well, I guess 4 of the other 11, since you already have the president of the Federal Reserve Bank of New York, that would be on this committee on a rotating basis. What's unique about the chair of the Board of Governors of the Fed and also the chair of the Federal Open Market Committee is they are the same. So that Jerome Powell is also the chair of the Federal Open Market Committee. So this committee is required to meet at least 4 times in a year in Washington, D.C. to discuss the federal funds rate. However, they have met 8 times a year since 1980. So they're required to meet 4 times a year. They have met 8 times a year since 1980. This Federal Open Market Committee influences the federal funds rate. So they make the key decisions that affect the availability of money and credit in the economy. So they are essentially setting what is the money supply, how much money is available, and in turn then impacts what the interest rate, they set these interest rate targets. So how does the Federal Open Market Committee actually conduct this monetary policy? Well, they do this through open market operations. So open market operations defined are the purchases and sales of U.S. government and federal agency securities by the Federal Reserve. So the Federal Reserve is actually purchasing or selling U.S. government and federal agency securities. Now, let's kind of discuss how they actually do this. The Federal Open Market Committee sets the target federal funds rate. This is called a policy directive. So what they will do is they will set a target federal funds rate. So what do they want that rate charged by banks trading excess reserves with one another? What interest rate do they want this federal funds rate to be? So then the Federal Reserve Trading Desk at the Federal Reserve Bank of New York will make the necessary transaction to influence what that target federal funds rate actually is. How do they do this? If the Federal Open Market Committee wants to decrease this federal funds rate, then the trading desk is going to make purchases of Treasury securities. So they're going to make purchases of these U.S. government and federal agency securities, which will end up decreasing the federal funds rate. If the Federal Open Market Committee wants to increase the federal funds rate, then the trading desk is going to make sales of these Treasury securities. Might be a little confusing. You want to make sure you understand these two decisions, okay? And what we're going to do on the following slides is actually go through a scenario where the FOMC wants to decrease the federal funds rate, so they purchase, and then another scenario where they want to increase the federal funds rate, so they sell, and hopefully it will make sense after these examples. So the first example that we're going to walk through is an open market purchase. So this is when trading at that New York, the Federal Reserve Bank of New York, the trading desk, will buy Treasury securities from a bank. So if they are buying, Treasury securities, apologize for that. If they are buying the Treasury securities, they are wanting the federal funds rate to actually go down. So let's take a look at a hypothetical federal funds rate scenario. So what we have is we have banks that have excess reserves. So those are banks that actually have more than the required reserve rate ratio that's set by the Fed. And then you have those banks that need to borrow. So we have these banks that need to borrow in order to meet that minimum requirement. On the vertical axis, we'll have the federal funds rate. So where this intersection is originally, that is the original federal funds rate. I apologize. Okay. So let's continue on. So the trading desk is going to buy these Treasury securities from a bank. Where does the money come from? Essentially, the Fed will just print the money. Okay, so if you look at your currency, if you're at your bank, you'll see it's printed by the Federal Reserve. When the Fed wants to buy these Treasury securities, they essentially print the money. So what they do is, then the trading desk receives the excess reserves from these banks, and then they pay the bank by adding to the reserves of that particular bank, right? So this bank with the excess reserves has treasuries and also has their excess reserves, right? So when the trading desk purchases these treasuries, so they're buying these treasury securities from the bank, the treasury part of the bank's reserves actually goes down, and then their excess reserves actually goes up. As a result, they have more funds to be able to lend out to these other banks. So now the bank has more excess reserves that they can now lend to the other banks. And with a greater supply of excess reserves, the federal fund rate will actually fall. And you can notice this in our new intersection between the demand curve, the banks with the excess reserves, and the supply curve of the banks with the excess reserves, and the demand curve of the banks that need to borrow. So how does this actually impact the economy? Well, now that the banks can more easily meet the reserve requirements, so at a lower cost, at that lower federal funds rate, the banks that need the excess reserves can now meet those, or the banks that need the required reserves can now meet that requirement at a lower rate because the federal funds rate has dropped. The banks now have more funds to lend to households and firms. The households use these new loans for consumption, so mortgages, car purchases, etc. And then the firms will also use new loans for expansion, so capital budgeting decisions. You know, your new assets, your long-term assets. Then once these entities repay their loans, they actually add to their deposits at the banks, and the economy expands as money supply expands. And this is because more money is available for purchases, so you have more business growth, more job opportunities, and so forth. We say that this is in theory because this means that the banks actually loan out those excess reserves that they now have. In theory, the banks could just sit on the cash instead of loaning it out, and that's actually what happened after the financial crisis. So the federal funds rate dropped. They did have excess reserves, but they were just sitting on it instead of loaning it out because of the previous scenarios that occurred within the financial crisis. Doing another quick little chart to just showcase how this decrease in the federal funds rate actually impacts, say, for example, small business loans. Let's say you have banks on the supply side. So you have banks with financing, and then on the demand side, you have small businesses. Once again, on this vertical axis, where they intersect would be the small business loan rate. Right, so this would be the interest rate on these small business loans. If the banks now have excess reserves because they're able to keep these they're able to meet the minimum reserve requirements at a lower cost, now they have more funds available, decreasing this interest rate on the loans that small businesses or other entities can actually obtain. So this is how it kind of promotes growth within the economy. So that's an open market purchase. On the other end, we have open market sales. So in this scenario, the trading desk is going to sell treasury securities to a bank. So in this case, they want the federal fund rate to go up. So the Fed essentially takes the money and the money supply contracts. So they sell the treasury securities, essentially forcing these Federal Reserve banks, these chartered banks, to take these treasury securities, and then they take the reserves from these banks to contract the money supply. So the trading desk subtracts from the bank's reserves. The bank, on the opposite now from the purchase, now has less excess reserves they can lend to other banks. So with a smaller supply of excess reserves, the federal fund rate actually rises. And so the banks have fewer funds to lend to households and firms, and the economy contracts. So you might be asking yourself, why would they ever have this open market sale? Why would they want the federal funds rate to go up and contract the economy? Well, sometimes you can have the economy growing so fast that a collapse is imminent. So what this monetary policy would end up doing is slowing down this growth so that it can grow at a pace that is sustainable. So this is called open market operations. So the buying and selling by the trading desk of these treasury securities to impact monetary policy, so to impact the money supply and interest rates. This open market operations is the most effective and the most common method of impacting monetary policy. Okay, so this is the one that is primarily done to impact money supply and interest rates. The second method for conducting monetary policy is impacting the discount rate. So what is the discount rate? The discount rate is the interest rate that Federal Reserve banks, so one of those 12 district Federal Reserve banks, charge on loans to banks within their districts. This discount rate is controlled by the Board of Governors of the Fed. So this is those 7 members, the chair, the vice chair, and the other 5 members. The discount rate is impacted by this. Vice versa from the Federal Open Market Committee helping with the open market operations. So remember that the federal funds rate that we just discussed is the rate charged between one bank versus to another bank, so one financial institution to another financial institution. The difference with the discount rate is that it's between the Federal Reserve Bank in that district and the banks within their district. So Federal Reserve banks loan money to financial institutions through what is called a discount window, and it's usually for emergencies. So if a bank is financially distressed, other banks aren't going to want to loan through the federal fund or with the federal funds rate on that bank in the event that bank that's already in financial distress won't be able to make the payment back the next day or whenever that may be. Typically is a one-day window. So what would end up happening is the Federal Reserve Bank would have to step in. They are considered the lender of last resort, and this is emergency related. So the Fed can actually influence the level and the price of reserves by changing this discount rate. So changing what these banks can actually borrow, at what rate they can borrow from that Federal Reserve Bank. They can impact the level and the price of the reserves. However, the Fed rarely changes this because there's no guaranteed effect. However, when there is a change, it's a signal of something, but there's no guarantee that's going to increase lending or decrease lending when this value is changed. For example, it was changed in 2007 and it had no impact. But then it was changed in December of 2008 during the financial crisis, and there was an effect, but it was because it was happening during an emergency. So changing the discount rate will have more of an impact in an emergency situation because banks aren't willing to trade amongst themselves because the bank taking on the responsibility is concerned that the bank in distress isn't going to be able to make their payment. So what they have to do is they have to go through the Federal Reserve Bank and go through that discount window in order to get the loan. So typically, the discount rate is higher than the federal funds rate because of this emergency situation in which it happens. The third method for conducting monetary policy, so changing the money supply and interest rates, would be changing that reserve requirement. So reserve requirements are the minimum amount of reserve assets that a bank must hold. In the previous example, I said 10%. That was just a total hypothetical. Once again, the reserve requirements, just similar to the discount rate, is controlled by the Board of Governors. So you'll notice that the FOMC, the Federal Open Market Committee, only deals with open market operations. The other two methods for conducting monetary policy, so the discount rate and reserve requirements, is controlled by the Board of Governors. So typically, you set it as a ratio of transaction deposits, this reserve requirements percentage, and the Fed can decrease or increase the reserve ratio, but again, the Fed rarely does so, okay? But in these times right now, we actually have had a federal funds increase or decrease, I should say, that has occurred pretty recently. This was recently changed in March of 2020, and let me show you what type of impact this actually had. So the monetary base is defined as coins and currency in circulation plus reserves. So when this PowerPoint was created, as of March 2020, the U.S. had a monetary base of 3.88 trillion. Now, I told you that the reserve requirement was changed in March 2020. It was actually changed on March 26, 2020, right in the middle or right at the very beginning of the COVID pandemic. And this value updated now as of June 2020, there is now $5 trillion of monetary base. So monetary base has actually increased 1.2 trillion since March 2020, and it's not primarily, but a good portion of this is due to the result that the reserve requirement on March 26, 2020 was decreased to 0%. So these banks were required to have 0% required reserves during this pandemic. So kind of a wrap-up of the impact of monetary policy. We will focus on expansionary activities and just realize that it's the opposite for contractionary activities. This is the open market purchases of securities, discount rate decreases, and reserve requirement ratio decreases. What type of impact does that have on reserves? Well, there's a greater supply of excess reserves in these three scenarios, so that would go up. Money supply would also go up because there's more funds to lend. So there's money supply as an increase. Credit availability would also go up because there's more funds to lend previous to the money supply. Interest rates would actually go down when you have open market purchases, when you discount or when you decrease the discount rate, and when the reserve requirement ratio decreases. And as a result, security prices should go up because there's more investment by businesses. Okay, so vice versa then would be contractionary activities. Make sure you have a thorough understanding of how these expansionary activities, the open market purchases, the discount rate decreases, and the reserve requirement ratio decreases, what type of impact they have on these 5 different categories. Continuing on, what else does the Fed do? The Fed's other responsibilities include serving as a bank for the U.S. government. So they handle funds for taxes and new currency issue. You might have seen federal taxes withheld on your W-2. This first goes through the Fed before it goes elsewhere, and they also deal with new currency issue and also the collection of worn currency. You can actually see with new currency issue which of the 12 Federal Reserve banks issued your currency. So if you pull out a dollar right now, you should see a letter and a number 1 through 13 on that currency, or 1 through 12 on that currency, sorry. And the number and the letter correlate with what Federal Reserve district that paper was printed. So kind of cool thing to do. Also, the Fed's other responsibilities deal with check clearing. So clear all checks of banks within your district. The Federal Reserve Bank will clear all the checks within of all the other banks. And this warrants discussing the Check 21 Act. The Check 21 Act was implemented in 2004. Before this, you used to have a paper copy of the check in order to cash your check. Okay, the Check 21 Act of 2004 authorized the use of an electronic image to facilitate paperless check clearing. I'm sure many of you have taken a picture of your check and deposited it in your check or in your account. This is a result of the Check 21 Act. This went into effect after 9/11 because when planes were derailed after 9/11, if companies weren't able to get their checks that were being carried on these planes, it could have a substantial impact or a substantial disruption to the financial system. So the Check 21 Act was implemented in 2004. Another Fed responsibility is wire transfers. So to electronically process transfer of funds, two different ways. One is called an automated clearinghouse, an ACH, a nationwide network jointly operated by the Fed and private institutions that electronically process credit and debt transfers of funds. You've probably all engaged in an automated clearinghouse before. So anytime you pay a bill online, that's through an automated clearinghouse. And then the Fed also deals with FedWire. This is a network that links over 9,000 banks with the Federal Reserve that is used to transfer deposits and make loan payments between participants. So those two different types deal with wire transferring. What else does the Fed do? The Fed's other responsibilities include economic research. So they deal with gathering, analyzing, interpreting economic data. You can see some of this economic research by looking at the National Bureau of Economic Research, so nber.org. And you can also access the Federal Reserve Economic Database at FRED. These are two websites that you can actually see some of this economic research that the Fed actually does. So monitoring the economy in a multitude of ways. And then they also supervise and regulate financial firms of the other banks within their districts. So what do they do when they're supervising and regulating these firms? Well, one, they inspect the banks to ensure solvency. Remember that solvency is your ability to make payments when they come due, so inspecting the bank's ability to make their payments on their loan obligations. And then they also monitor banks that are considered too big to fail. I'm sure you've heard this phrase before, too big to fail. Well, what does that mean? A too big to fail bank is a bank that is too complex and too large, or they're considered too complex, too large, and if they fail, they could collapse the financial system. Okay, so banks like JP Morgan Chase, Citigroup, these are examples of banks that are considered too large to fail. They believe, the belief under the Dodd-Frank Act is that if there were any trouble and these banks were actually going to fail, they would have to bail them out to preserve the financial system. What this does then is it creates what is called a moral hazard. Okay, so if you know you're going to be bailed out because you're so big, and if you fail, the financial system in the United States will collapse, you will take risks that you otherwise wouldn't take because of the fact that you know you're going to get bailed out. So we have this thing called a moral hazard. So a real basic hypothetical example to showcase what a moral hazard is. Typically, when you have an investment, you have a low-risk investment or you have a high-risk investment, right? So when you make a low-risk investment, you have two different scenarios. You have a small gain or a small loss. Again, this is a very hypothetical example. So you have a low-risk investment. In this low-risk investment, you have a small gain or a small loss. As a bank manager, your compensation in these two scenarios would either be a small bonus if there's a small gain. If there's a small loss, typically you'll just have no bonus because it's just a small loss. Now let's consider a high-risk investment. In a high-risk investment, you also have two opportunities or two options. You have a large gain or you have a large loss. Now, if you have a large gain, as a bank manager, you're going to get a large bonus. But if you are considered one of these banks that is too big to fail, if you have a large loss, instead of actually receiving that loss, you end up getting bailed out. So this large loss could threaten the solvency of the bank. You end up getting bailed out. And so you have this moral hazard. If you consider what would most... If you think about a bank manager, what do you think a typical bank manager may do? They may take this large gain or this high-risk investment in the event for hoping for a large gain and that large bonus, because in the event of a large loss, nothing happens to them. They get this bailed out. And who ends up dealing with the bailout problems? Typically, it's taxpayers, right? So the Dodd-Frank Act actually monitors these big banks that are too big to fail and monitors the amount of risk that they're taking to try to make sure that these banks are monitoring the riskiness of the investments that they take so they do not incur this large loss that would then require a bailout scenario. So the Fed actually is supervising these banks within their district under the Dodd-Frank Act. Okay, so that concludes our discussion on the Fed. Make sure you can answer these questions. So how is the Fed structured? So you got your Board of Governors, and you've got the breakdown of the Federal Reserve banks. You also have what are the Fed's goals and responsibilities? How does the Fed conduct monetary policy? We talked about 3 different methods. What is the FOMC? What's their primary duties? Who makes up the FOMC? How does an open market purchase work? What type of impact does it have on the federal funds rate? And so what is the theoretical impact on the economy then? And then what is the discount rate? What is the reserve ratio? The 2 other methods of monetary policy by the Fed. So that is Unit 3 here or Lecture 3 of Unit 1. Don't forget to complete your check-in question on McGraw-Hill Connect. And if you have any questions about today's discussion or today's lecture, please don't hesitate to reach out. I hope you all are well, and I will talk to you soon.